Good morning and welcome everyone to the Moneycontrol live stream. You're watching the opening bell and I'm your host Nickey Mirchandani. Indian stock market set for a cautious start amidst negative global setup. Technical analysts suggest that the short-term trend of Nifty remains weak and any upside bounce from here on could counter a hurdle around that 21,700 levels. GIFT Nifty indicates a marginally negative start coming in for Dalal Street for broader index with a loss of around 30 odd points. US stock market closed in rest overnight as investors remain cautious ahead of the US inflation data. Asian market, they meandered close to that 1 month low level. Japanese stock set to extend gains after hitting in a 33-year high in the previous session. Talk about the FIIs, the sold shares worth around 990 odd crore and DIIs have purchased equities, but the amount remains minuscule out there, 104 odd crore. FNOQs, well, FIIs have been the net buyers in index futures. Along with that, they've also been the buyers in Bank Nifty futures and also buyers in the index options and stock futures. So there is this whole trend of buying coming around. FNO ban, well, what still remains in the ban is Balrampur Chini Chambal Fertilizers. Essentially, Delta Corp also is in the ban. Remember, it's reported in the numbers. Escorts, GNFC, IEX, National Aluminium Company, SAIL, PEL and Bandhan Bank, Hindustan Copper. These are some names. Looks like there's no fear left in the market of the kind of FNO ban list that we've seen. Out of the ban is Z Limited. Option Qs is the indicator has come below that one level, 0.88 compares to that of 0.84. But let's get going with the strategies, levels and top recommendations of the day with Rajesh Palviya from Axis. Morning there.
Good morning, Nickey.
Well, I don't know if it's going to be a good start or no. Looks like it's a sell on rally markets. What's the texture suggesting and immediate support and resistance level both for Nifty as well as Bank Nifty?
So, since last couple of trading sessions, Nifty is in very tight range. 21,500 is acting as a support, 21,750 acting as a resistance. So, this range is playing out since last couple of trading sessions. But on the Bank Nifty, we have seen a significant amount of profit taking from recent high. And now Bank Nifty slipped below to 47,500. That was the important put-based concentration on weekly as well as on the monthly also. So, Bank Nifty may be a dragger at this moment. If it remains below to 47,500, then we may see further more pressure in Bank Nifty, and then it could go further down towards 47,000, even 46,800 kind of level on the downside. But on the Nifty, still put writers are having their writing position at 21,500, 21,400 strike. So that might get attract again, buying interest around this range. So maybe we can see towards 21,400, 450 kind of level on the Nifty spot may attract again buying action. But on the higher side, 21,700, 750 is a major critical resistance area or supply area for next couple of trading session. Until we are not able to cross those levels, we are likely to remain in range for some more time. To play out this range-bound behavior of Nifty, we are initiating here short straddle strategy where we are selling 21,550 call and put. So by doing this, we are pocketing around 170 rupees as an inflow of premium. So our downside protection will break-even point would be at around 21,370, and on the higher side, 21,730 would be our break-even on the higher side. And as we are projecting that range-bound behavior of market towards this weekly expiry, so I think this short straddle strategy would be a profitable trade for next 1 or 2 trading session. So one can initiate short straddle of 21,550 strike. Once this premium shrink to 100 rupees, one can book profits. For initiating this straddle, you can keep a stop loss of 220 to go a short straddle.
Okay, so you're not typically anticipating or let's just say reading into a sharp fall coming in the markets because technically the texture has been typically weak. We've seen the fag and profit booking which took over in the previous session of trade, though it was a strong start, but not much of it could be captured. Do you think essentially these are the markets where people, if they've made the profits, kind of book it, sit on cash and perhaps look for opportunity now for dips to come in so that they can initiate the fresh long positions?
So definitely, we have seen very strong rally in last couple of months, and already most of the traders, investors are sitting on a huge amount of profit. And ahead of earnings season, yes, there is a bit cautiousness in the market. Global cues are still on the volatile side. So I think yes, some profit taking is happening, but I don't see any aggressive or major down move in this month. Maybe we can see some pressure on the index, but on the lower side, again, overall structure is bullish. So still we are having buy and dips kind of strategy in the market. So maybe in decline, we are ready to deploy again the fund, and we are very much bullish that again traction is going to be there on the buying side, and we may see again rally to continue further.
All right, what I'd also want to address in early deals is the upgrade which has come through for Bharti Airtel. BofA Security essentially has given in a double upgrade on Indus Towers and also Bharti Airtel. That these are the two stocks that we're going to be talking about in just a jiffy. But Nifty 50, we're looking at losses to an extent of 0.1%. It's a flat start with negative bias coming in for Indian equity markets. Let's talk about Bank Nifty. Well, let's look at that. Bank Nifty, we're looking at losses to an extent of 0.25%. So that's also one thing that we need to watch out for. Apart from that, the mid cap and the small cap index, that also is showing some amount. It's actually a flat trend coming in for the markets. Small cap index, also 0.2% of gains coming on that one. Let's also talk about the other indices that we have. Nifty IT essentially 0.3% of gains clocked in for Nifty IT, and Bank Nifty also is the one that we of course have addressed in pharma. Typically that's the entire defensive space, IT, pharma. They seem to be. Also to bear in mind the fact that TCS and Infosys, the big boys, will be reporting in the numbers. They're officially going to kickstart the the Q3 earnings season, the December quarter earnings rather, and that remains to be seen how the flavor and the texture actually stacks up. But at this point of time, at least from the face of it, it looks like a very weak trend coming in for the markets. Top gainers and the top losers that we have overall for the markets. Let's pull that up just to see where the momentum is lying right now. Well, HCL Tech, Adani Ports and Cipla. These are some of the top gainers that we have. M&M, Bajaj Auto and Sun Pharma. Another top gainers that we have this morning. Well, also let's talk about top losers of the day. Some amount of traction clearly has come in on the IT stocks ahead of the earnings season clearly. ONGC, BPCL, NTPC. These are some of the top losers that we have. Apart from that, Coal India, Power Grid and Hero MotoCorp are some of the other top losers that we have on the list. Rajesh, quickly come in on this one. What do you make out of this open? And Bharti Airtel is the one essentially that I'd like to chat on account of the upgrade that has come through from BofA Securities. What do you make out of it and what's the top recommendation there?
So Bharti Airtel overall structure is bullish, and the stock is making a series of higher top, higher bottom formation. That clearly shows that sustained buying action is intact in the stock. So we believe that Bharti Airtel may continue further more upside towards 1,095 to 1,120 kind of level in near term to short term basis. So those who have already bought the stock or wants to buy, they can initiate their long trade at the current level also. Even in the decline also, one can buy and accumulate with stop loss of 1,035. That level needs to watch. That level is very important for this near-term trade, and we believe that upside momentum can continue in the stock in the near-term basis. Stocks which we like at this moment, that is from first is Indigo is looking promising. Overall structure is bullish. Stock is holding about 3,000 kind of level. Looking at the data setup in last couple of trading session, we believe that Indigo can show some traction towards upside. We are projecting target toward 3080 with stop loss of 2970. The second stock that we like from the cash segment, that is Poonawalla Fincorp. Very strong buying action in last couple of trading session, and we believe that in the kind of breakout which we are witnessing on daily as well as on the weekly chart, we believe that Poonawalla Fincorp can continue further more upside towards 495 500 kind of zone. And third stock is from Capital Goods, that is Siemens. Very strong momentum. Stock managed to give breakout of its previous swing high of August 2023, looking at the overall structure, we believe that this space can continue for the more upside. So Siemens can exhibit upward momentum towards 40 to 50, 40 to 80 kind of level. So one can initiate buy here with stop loss of 4150.
All right, Rajesh, we're just going to leave it at that. And thank you so much for taking out the time and having this conversation with us. All right, it's about time we address how cautious one needs to be in a market like this. There is complete fear. Actually, let's just say there is no fear left in the markets at this point of time. And that's where the room of mistake, or let's just say the room of error, completely expands at this time. You have 12 stocks which are on F&O ban, and that is something that you need to watch out for. But Nimesh Shah from CNBC TV-18 joins us to tell us about the top 10 reasons why investors need to be cautious on a market like this.
Well, it's very difficult to talk about anti-consensus view in this kind of a market, right? Everybody wants to only listen to the positive news. There is so much of excitement and euphoria, so to speak, in the broader markets as well. But the data is saying something else, right?
Today, you're the bearer of bad news. You kick-started off the Jan series typically with all the good news and all, stocks typically that came in from you were Praveg, which did exceptionally well. Yeah. Some exuberance seen in that stock also.
But let me take Praveg's example as well, right? I mean, just that they are into Lakshadweep, they're going to launch into Lakshadweep. They have got some presence in Ayodhya as well. The stock is now commanding a market cap of 2,000 crores, and you should just look at the numbers. You just cannot justify this kind of valuations.
40% uptick in 2 days.
Exactly.
Some crazy.
So that's the kind of craziness which is there in the market, which is why I thought it's very important to look at some data, and why I feel one needs to be a little caution at this point in time. I'm not saying markets can fall, there could be a vertical fall, but one just needs to be a little careful in terms of valuation, in terms of other data as well. So let me just go through the data one by one. The first data, if you look at the January series, historically January is a weak series. Out of 17 times, 11 times in the history it has given negative returns. But we also need to take into account that in this particular Jan series, we had a very strong November and December series for the Indian markets. We've been the rank outperformers for calendar year 23, and especially the last 2 months, the November and December, were very, very strong across the board. We've seen big moves in those 2 months. So we are actually sitting on a lot of gains from November and December, and typically Jan has been historically a weak series. So that's something need to put into context that.
But it's also a series which typically is coming in ahead of the interim budget, and that too ahead of general election.
Yeah.
You think that could be a game changer of sorts?
Kind of. Again, I'll come to that point of the general elections as well. But from a positioning point of view, the third important point to track is the F&O data. While the PCR is not suggesting an overbought market, and that's largely because the Nifty stocks have not done well. But if you look at individual names, 12 stocks as we speak are in the F&O ban. And I was just looking at the past data in the January series, in the September series last year, September 15th, 12 stocks were in F&O ban. And after that, the markets corrected 7%. The Nifty corrected 7%, right? So that's a history to figure out that why one needs to be careful. Even if you look at the peak, in terms of sentiment or valuations, we are at the peak. Peak sentiment, everybody wants to be only talking about bullish notes, and everybody only wants to buy, nobody wants to sell. So the sentiment is quite peak. Even in terms of valuations, at 20 times or little over 20 times on Nifty PE, there has been only 8% chances of higher moves in the last 18 years of history. Okay, so in the last 18 years, whenever the Nifty PE has gone above 20 times, we've seen only 8% of the times markets trading higher. Okay. So that's again a history to suggest that in the short term, in the very near term, the markets tend to underperform and correct a bit. So even from that valuation point of view, there is a bit of a discomfort in the market. So again, if you look at India's own history versus the bond yields, okay, even that is suggesting that the equity valuations are at peak and there is not much upside left purely from a near-term perspective.
Right.
So that again shows that there is some sign of caution is required at these levels and at this market. Even if you look at India's own history, historical PE multiples to what we are currently right now, we are at the record levels, and from there typically markets have underperformed. So
I'm going to play a contrarian there.
Yeah.
I was actually having a conversation with Ashish Somaya yesterday, and that's what he brought to the table, that he said the first half essentially could be a period where you can actually see some amount of exuberance in the run-up to the events like budget, general election. The second half typically will be rather dull or lackluster, given most of the important events will be out of the way.
Yeah.
So that's one. And valuation bit that I'd want to highlight is, of course, India also, I'm sure you would agree that they've been the outperformers across the globe, even in the period when other equities weren't really performing. So the valuation also is on account of the fundamentals and the growth story that markets have captured.
So the argument is, yes, India is a growth story. India is a sweeter spot in the emerging market basket as well as in the global basket. But ultimately, in the equity markets, I've learned in the last many years, it's the valuation which finally takes up like a bigger call. Right now, the sentiment is quite high. Everybody only wants to buy. The domestic flows are very strong. Everything looks good, right? And which is the reason why we need to point out the key reasons on why one needs to be cautious. As I said, historically, I mean, if you look at India's history, of course, we've always traded a premium to the emerging market basket. But even to our own history, in the last 18, 19 years, we are at a slightly higher levels compared to what it was in the last many years. I was looking at and even if you look at some big brokerage notes. Okay, Bernstein put out a note on the first week of January saying time to book profits. Okay, yes. And they've actually downgraded the mid cap and small cap. Look at the CLSA note 2 days back. He said no time to be greedy. That's exactly what we are trying to convey. We are not saying markets will fall big time or there is now everything is done with and we should just sell out. But time to bid caution and time to book profits is what the key message which is coming in from most of the brokerages. In fact, the CLSA proprietary, they have a proprietary India Bull Bear Index that is at 95%. Which means that 95% of the people are feeling bullish on the market. And when typically that's the kind of level we are there on one side, you don't see too much of upside from those levels. So that's the clear message coming in from CLS as well. And the last bit, you spoke about the interim budget, but that's anyway going to be an interim budget, so not a big trigger. But the general elections.
But it's also something that it's going to be a continuity and stability of policies coming around, given that the government, from what we've factored in, will remain constant even for the third term.
Absolutely. But the bigger trigger is going to be the general elections. And even from a general election point of view, what we saw with the state elections and the exit polls, it clearly suggests the third term for Mr. Modi, which means the continuity in the government will continue. And that's going to be a big trigger for the markets. But again, the point is it not priced in? We've seen a lot of rally in the PSU stocks, a lot of rally in stocks where the government seems to be quite focused on. So from that perspective, lot of analysts and brokerages believe that they are actually priced into the valuation. So maybe
I think the bigger question here is whether or not BJP will win is not the question. Yeah. Whether or not BJP will win with thumping majority is something that we need to watch out for, and that could probably lead to an upside.
If you ask me from a market perspective, I've been talking to so many people, I think even the thumping majority is priced in. Okay, I mean, if you ask the smart guys, they would say that it's a given. Okay, so it's in the price. It shows up in the valuation in terms of stock prices as well. And in the last bit, if you track the markets closely, these are typical signs of a suckers rally. Okay, last week, if you see last week, every single day, we saw one sector going up and individual stocks going up 8-10%. One day it was real estate, one day it was pharma, one day it was infra, and for no reasons. Okay, there was actually no reasons or explanations to why the stocks have moved up 10-12% in a single day. So that's a kind of a suckers rally, and that's what even JM technical analysts put out a note last week saying, looks like the markets are in that zone of a suckers rally. It will suck a lot of people. And I know and there is a lot of FOMO as well. And when I talk to a lot of people in the market, clearly there is a FOMO feeling like, oh, I missed out this, I missed out that. So again, that again shows that one needs to be caution. Stay close to the exit is what JM had said in his note as well. So look at technical analysts or fundamental analysts. The feedback is, yes, India is in a sweet spot, but a lot of things are already priced in. So one need to be a little caution and one need to be a little careful as well as far as the mid cap and broader markets are concerned.
All right, Nimesh, that's beautifully put and summed up. We're just going to leave it at that, and thank you so much for taking the time and joining us. Now let's navigate our discussion around the fundamental side further. Well, we've already addressed in top 10 reasons to be cautious, but let's also understand from Anshul Saigal what is his view, what does he suggest about the valuation and essentially the strategy that now investors need to take in a market like this. Morning there.
Morning, Nickey.
All right, I was just having a discussion around with a colleague who suggested that it's about time that we be a little more cautious on the market, given the fine texture now suggests that most of the positives seem to have priced in. What do you recommend? What's your opinion? And do you also feel that the valuations are stretched at this point of time?
It's a 8 standard calculation. You put the Nifty EPS, and on top of that, you put Nifty current valuations, current absolute number, and you will get a price to earnings ratio which looks extended for sure. I mean, 20 times price to earnings, no one can say on Nifty is cheap. However, we are in a pond that is India, and we are too constrained by this pond. We don't look beyond this pond. If you look around the world, you will notice that over the last 5 years, the Hang Seng index is down 37%. If you look at China, over the last 5 years, I think it's up about 17%, maybe in the last few days, even less so. If you look at Korea, last 10 years, it's done about 1% CAGR return. And of course, India in the last 5 years is up about 100%. Even US has done very well, which is about 80%. Now, if you're saying that India is going to correct, then we have to ask ourselves that will this correction be only country specific, or will this be because of global reasons? And if it is because of global reasons, then will say a Hang Seng, does a Hang Seng also look expensive? Does a China also look expensive? Say even a UK, does that look expensive? And so will that correct as well? The answer that I see is no. And as a result, you can make a case that India at these valuations will be an underperformer. But with so much skepticism around, speak to 10 people, 9 will tell you markets are expensive. They've done very well last year. And as a result, this is the time to book profits. With so much skepticism, I would say that it's not a given that India will correct it on an absolute basis. There is too much money on the sidelines which is waiting to come in and invest. As a result, while I'm cautious, but I'm not a skeptic.
All right, the point is well taken and also beautifully made, I would say, because there is a sense of, just the markets are flying. You've seen mid-cap and the small-cap stocks typically doing extremely well, and that's where some amount of fear is perhaps creeping into the markets. But what's your strategy now? Because even the large cap stocks, which seem to be otherwise a place where market participants are now probably shifting their portfolios to, are at an premium as compared to the historical averages. What do you think about it? And do you also think that large caps is the preferred bet?
Nickey, when we talk in terms of the large caps, typically we are speaking about the Nifty index and saying that at 20 times Nifty index looks expensive. But we've got to keep in mind that this is an average of 50 stocks. And if you look at the extremes of these 50 stocks, say you take a Godrej or take not Godrej, Nestle, take a Titan, etc. Those trade at, on a trailing basis, say over 80 times price to earnings. And on the other hand, say the largest bank in the country by market capitalization, that bank trades at valuations it has never traded in the past. And this is despite growth picking up in that bank. Look at some of the other, the largest PSU bank, it trades at under 10 times earnings. That doesn't look expensive to me. So there are extremes in the markets where certain segments of the markets are trading at very high valuations, and you can justify valuations in certain other segments. And as a result, I would say while there is froth in the small and mid cap space, but that froth doesn't seem to be the case in the large cap space. I would definitely say that this is a time to be cautious in certain segments of the market. But say the large caps, I would veer towards them. I would say that is one segment which in relative terms looks quite attractive in valuations at this time.
So private banks...
I'll make one more... Sorry.
Please go ahead.
I'll make one more point. We have to bear in mind that this is an election year, not just in India, but also in the US. And if you see election years in the US, you will notice that election years have been years where the US has pumped the economy with capital, because the incumbent wants to go into the election with the wealth effect behind it. And so we have to keep that factor also in mind, that if they were to taper down QT, And if they were to lower interest rates, given that inflation has come off, what would happen to the markets globally? Because US at the end of the day is the fountainhead of all liquidity. And will India be left behind as a result? Those are questions we need to answer.
Since we have addressed the large cap bets perhaps being perhaps preferred bets as compared to the broader indices, mid cap and the small cap stocks, within large caps, what do you like? Essentially, IT is one that I'd really want to talk about. You think that's the sector perhaps which is now bottomed out? Two of the major companies, TCS and Infosys, will be reporting in their earnings. It's expected to be a dull quarter, but what do you expect out of it?
Nickey, I think that IT has seen over a 2 years, over a 2 year period, it has seen a sort of valuation correction, given that some of these stocks are on an absolute basis down, some have done nothing over 2 years and earnings have caught up. So somewhat of a correction has happened in these pockets. But I would say that this is not a cinch. This is not a given. You can't thump the table and say that IT is the place to be at this moment. Of course, if you take a macro call and you say that the US economy with interest rates coming down should start doing well, and that should percolate into IT stocks, then clearly that macro call plays into IT and you could very well buy into IT. But valuations really, I would say that stocks that used to trade at 14, 15 times price to earnings, even today are trading at 25 times price to earnings. So one would have to, on a very stock by stock basis, look at IT. There are, however, in the large cap space, very attractive opportunities, even in the IT sector. But those are stock specific special situations that one should be looking at rather than the sector as a whole.
What are the stocks essentially that you like, Anshul?
I wouldn't, so let me not name the name, but I'll give you a hint. And I assume that it will not be too difficult for you to figure out. Now, there is a company in the large cap space where management has changed recently from 1st of January. What has happened is that over the years, there is a lot of inefficiency which has built into this company because it used to cater to the telecom sector. And margins in this company are at least 10% points behind some of the leaders in the sector. While leaders are in the range of 25, 26% EBITDA margins, this company is at about 15 odd percent or even less in the current year. Now, we anticipate that these inefficiencies will be taken out of the system. That is low-hanging fruit. And when that happens, say a 2-3%, maybe even a 4% uptick in margins is quite likely. The company trades at rock bottom valuations, while the sector trades at 25 times price to earnings. This company trades at 14, 15 times price to earnings. So if margins look up, it's quite likely that this company will also see multiples expanding. So this is more a stock-specific arbitrage opportunity rather than a sector-specific opportunity that I'm talking about.
All right. It's apparently Infosys, which has been in news recently as several senior leaders have quit to join the competition. That's one. And also Wipro, for that matter, is also seeing some amount of recheck which is coming through in the management. So essentially these two counters. But within the large cap, also let's now shift our focus more towards the companies rather in the run-up to budget. You think defense and power again would be the theme that will perhaps dominate the gains seen at Dalal Street, because we haven't really seen that amount of traction building up as yet for these companies, at least for the year 2024, taking away the performance that they've seen in the previous year?
Many of the defense companies have fully played out on the opportunity in the short term. Of course, the long-term opportunity is quite tremendous, but in the short term, valuations seem to be pricing in most of the upside. So one needs to be cautious in the broad spectrum of defense. There are, I must say, in the same breath, I must say that there are opportunities which are, again, stock-specific, quite lucrative even in the defense space. On power, India has, particularly in thermal power, not seen any new capacity getting added in the last, say, 15, 16 years. And clearly, that leaves room for upside. Demand is only going up. and the sort of capacity addition hasn't kept pace. In this scenario, clearly we see that there is opportunity in power sector. Again, most of that opportunity is already priced into valuations. We know what happened in power stocks last year. So it will again be a stock-specific sort of opportunity in this sector, and you'll have to be very cautious in what you buy into in this space. But by and large, we see tailwinds in both sectors.
What I'd also want to chat about is the online gaming companies. A bit different bet out there, but also the one that needs to be spoken about. Delta Corp, essentially, it's also reported in the numbers. There have been few regulations around the tax and, of course, a sharp fall which has come through. What's your assessment after the correction that we've seen in these counters? What's your assessment?
See, there has been a resetting of valuations given the new realities on taxation. Clearly, that is a bummer, and it'll impact demand for sure, because such a large impact on transactions on transaction cost is clearly going to eat into profits. Having seen that, I think that now it will be a performance-based sort of valuation uptick in the company, if at all. As also, if there is a event which is favorable, that is, you see something like the tax being taken back or something of that sort, then of course there will be a re-rating in the stock. But aside from that, I don't see any other unique situation in this name at this moment. It is an attractive space, but clearly hobbled by issues which are beyond our control.
All right. Some of the stocks are also not preferred if there is some amount of government regulation and control within the sector. That's also a strategy most of the investors around the street actually adhere to. But Anshul, last question that I have for you in that case is what theme typically would you recommend at this time, which looks interesting? And also, do you think it's a year where we'll see defensive perhaps being more in the flavor? Talk about IT, talk about pharma. Do you think they will kind of dominate gains at the last street?
Nickey, you will see this year growth being chased. So stocks, rather than looking at sectors, while I do think that both financials and pharma are attractive spaces to be in, but I would say that more than that, it is going to be a very bottom-up, stock-specific kind of year. We've typically seen when you have outsized rallies in the previous year, the next year is a much more difficult year for equities. It's a much more narrow year, and so you need to be stock-specific and do much detailed research on understanding where growth is not priced in to make money. This is going to be that kind of a year. I see opportunity around. I must say that there is so much opportunity. I'm salivating. I see opportunity in chemicals, pharma, financials, even in IT, capital goods, manufacturing. But these are very stock-specific opportunities rather than this being a sector call as a whole. So I think that there will be money made. There is money on the table definitely in the current year. But one will have to be much more precise, much more sharp in making that money in this year.
Anshul, 30 seconds. Out of the 5-6 sectors that you've just suggested, one top theme that you think will do extremely well and why?
So if you ask me, I think that I think that there is going to be in the CDMO space in the current year a lot of activity in India, as also in the pharma space in particular. I think that companies which are doing complex generics and companies which are doing CDMO business in the current year are going to see significant tailwinds. Why I say that is because many of these companies over the last 2-3 years have added to capacities. They have also, invested behind new drugs, new complex drugs, and this is the year where business will come to fill these capacities. So we will see operating leverage play out. Valuations, while they are to some extent not cheap, but those valuations, as operating leverage plays out, will get expanded further. I think that this is one space where we will see opportunity in the current year. CDMO and complex generics within the pharma space.
All right, Anshul, we're just going to leave it at that. And thank you so much for offering a very different perspective this time around. With this, it's a wrap. And thank you for taking out the time. But essentially, two stocks that I'd like to highlight here is Delta Corp. Of course, the numbers have come through and the numbers aren't really looking very pretty. When you talk about Delta Corp, there is a 15% downtick in the top line performance of the company. EBITDA is down by 45%. The margins are at 24% as compared to 37% in the previous quarter, or let's just say corresponding quarter of the previous year. Online gaming company has essentially, the segment has reported an EBIT loss, which is weighing on the performance of the company. And Spicejet, that's another one which is seeing some amount of momentum. Carlyle Aviation Partners is interested in Spicejet airline. That's at least the report that we're picking up. And Carlyle Aviation holds around 7% stake in Spicejet, and Promoter Singh holds around 57%. So it's going to be an interesting permutation combination. And Polycab India, after the sharp uptick, let's just say, beg your pardon, correction that has come through in the previous session of trade, there is finally some recovery that has come through. But with this, it's a wrap. And goodbye from the entire team who puts this piece together. Thank you so much for watching. Please do post your feedback for us in the comment section below. Follow us on the link at the bottom of your screen. And for rest of the updates, stay tuned into moneycontrol.com and Moneycontrol app.